Hello everyone, this is Gokulpriya to present a video about cash conversion cycle and its terminologies which is involved in cash conversion cycle. So before going in it, let me discuss about what is business. Business is all about economic activity. It includes the exchange of goods and services. It's nothing but trading. It is a systematic attempt done by the business person in order to gain profit. It also satisfies the needs of the customer. So in business, it involves a big cycle from making a raw material into finished goods. Any business entity, whether it is providing services or selling goods, it has three crucial elements. The three elements are input, output, sold for cash received. So if the inputs converted into output means it is production, and if the output get converted into sold of cash received means it is selling, and if the sold of cash received gets converted into input again means it is purchasing. So in order to run the business, this is the most crucial element in it. It involves 5 more other elements like sources of raw material, engaging laborers into work, selling the finished goods to the market, accounts payable and accounts receivable. So this business involves cash flow in it. Without money, there won't be any business occurring in the world. Money plays a vital role in business. There comes the cash conversion cycle. So before going to it, let me tell you about the three terminologies which is involved in cash conversion cycle. So the first one is inventory conversion period. Second one is receivable conversion period. Third one is cash deferral period. First, let me explain the first one. So the inventory conversion period. All these three terminologies are expressed in time and date. So the inventory conversion period refers to the conversion of raw material into the finished goods. So the period taken for conversion of raw material into the finished goods is called as inventory conversion period. So the formula of inventory conversion period is inventory divided by sale per day into 365 days. So the second one is receivable conversion period, in short RCP. It is defined as the average length of time required to convert receivables that arose out of sale into cash. That is, the time taken for sale and cash is known as receivable conversion period. The formula of receivable conversion period is receivable divided by sales into 365 days. So the last one is payable deferral period. So the payable deferral period is average length of time between the purchase of raw material and the time that we actually pay for the raw material. That is, the formula for payable deferral period is average accounts payable divided by cost of goods into 365 days. So using these formulas, we can easily find the cash conversion cycle. I would like to summarize this like cash conversion cycle formula is inventory conversion period plus receivable conversion period minus payable deferral period. So this is how the cash conversion period is found. The cash conversion period is used in the business activity. It is basically an indicator of business cash flow and the liquidity. It measures the time when a company pays cash for it and pays cash for its inventory until it receives cash for its inventory. So it is an indicator of how fast the company can convert initial capital investment into cash. So the time period taken for the cash invested in operation in order to change to cash received from operation, the time period between these two both is known as cash conversion cycle. So if there is an increase in cash conversion cycle, it is a negative free cash flow, and if there is a decrease in cash conversion cycle, it is a positive free cash flow. Companies with low cash conversion are often regarded as a best management. Companies like Apple has negative cash conversion cycle because they have such a long time frame to pay their suppliers. So, in short, the cash conversion cycle formula is used to determine how well a business manages its working capital. The shorter the cash conversion cycle with other cash flow computation, the better the organization is at selling inventories and recovering the cash while paying suppliers. The cash conversion cycle should be compared to other organizations in the same industry and followed on regular basis. Comparing a company's conversion cycle to the past year's cycle, for example, might aid in determining if it is working capital management is deteriorating or improving. Furthermore, comparing a company's cash conversion cycle is to change the policies relating to the credit purchase and credit sales. The standard of payment of credit purchase or getting cash for the debtors can be changed on the basis of reports of cash conversion cycle. So, the cash flow statement and the cash conversion study will be helpful for the cash flow analysis. The cash conversion cycle reading can be compared among different companies in the same industry segment to evaluate the quality of cash management. So, in short, cash conversion cycle helps the business for the conversion of raw material into finished goods and to make profit in the company. So, let me example this with a small diagram. This diagram is the horizontal line denotes the number of days needed to complete the product making and selling. So, the first dotted black line denotes the receive of raw material, and the second brown line denotes the payment of cash of raw material. The third dotted purple line denotes the selling of finished goods. The fourth green line denotes the collection of receivables. So, let me explain this. Like the days required to receive raw material and to pay the cash for the raw material denotes the payable deferral period, that is also known as cash deferral period. So, in short, we can call as CDP. The day needed to receive raw material and to sell the finished goods denotes the inventory conversion period, that is ICP. The day needed to sell the goods, finished goods and collect the receivable denotes the receivable collection period, that is RCP. So, in short, this diagram helps us to understand the cash conversion cycle more easily. So, let me explain you with a short example. Let us take CDP as 30 and ICP as 72 and RCP as 24. So, what is the CDP? Cash deferral period, and ICP is inventory conversion period, and RCP is receivable conversion period. So, now applying the cash conversion cycle formula. So, what is cash conversion cycle formula? Inventory ICP plus receivable conversion period minus cash deferral period. So, this is the formula of cash conversion period. So, let us substitute the numbers into the formula. First, 72 plus 24 minus 30. So, there comes the answer as 66 days. And this is how we used to calculate the cash conversion cycle. So, now the time taken for conversion of raw material into finished goods is 66 days. And this is how we define the cash conversion cycle. I hope this information is useful and understandable. Thank you.